I'm Eloise Goulder, head of the Data Assets and Alpha Group here at JP Morgan. And today I'm really pleased to be joined by my colleagues Andrew Tyler and John Schlegel to talk about US equities following yet another leg higher in recent weeks, with the S&P 500 now up 17% year to date. Drew is head of the US Market Intelligence team, and John is head of the Global Positioning Intelligence team. And as always, I'm looking forward to hearing their perspectives on markets from here. So, Drew, John, thank you so much for joining me here today.
Hi, Eloise. Thanks for having me. Great to be here.
Yes, great to be chatting again today.
So, Drew, can we start with you? As I said, US equities have had an incredibly strong start to the year, up 17% year to date now. And in fact, they are inching higher every day, up over the last 6 trading days. So, Drew, what do you think has driven this latest leg higher?
So it's really a continuation of the mega cap tech trade, including both the Magnificent Seven as well as semiconductors. So real recently, you've seen the macro data come out mixed. And so what I mean by that is inflation data confirms the disinflationary trend remains in place, but the growth data has declined. And so the market is really uncertain about whether this growth slowdown is a normalization back to pre-COVID times or whether it's a trend showing a deterioration that's going to ultimately lead to a recession. In either case, the stocks that benefit the most are those that have earnings that are not as correlated to the business cycle, and those companies who also have strong balance sheets, which leads you back to the mega cap tech companies.
And it's been a very narrow rally year to date, hasn't it, with mega cap tech leading, and I think the S&P equal weight is only up 3 or 4% year to date.
Yes, that's correct. So that would be one measure of breadth. But if you also kind of look at the percentage of companies that are trading above their 50 or 200-day moving averages, those are actually much more aligned with what we're seeing over time. So what this tells you is the performance itself is being driven by a handful of companies, but it's not as though every company is necessarily negative, right? So I think that point matters.
That makes sense. Thank you, Drew. So, as you say, lower inflation has definitely been a driver of markets higher, as have the strong bottom-up earnings from segments including tech. So when we look forwards, Drew, what are your views from here? I mean, you have been bullish, as you've articulated many times on this podcast series for over a year now, but with the S&P 500 rallying consistently, and in fact, the index is up 36% from October lows, where do you see risk reward from here?
Yeah, so I think in the very short term, we still go higher, and that's going to be mostly based upon the positive seasonality. So for example, July has been the third best month of the year for the S&P 500 dating back to the year 2000. And in fact, we've seen 16 consecutive positive Julys from the NASDAQ 100. So it's a pretty good trend there. Maybe we see 17. As mentioned before, I think it's really the mega cap tech companies that they're going to kind of tend to perform in any economic environment as long as their earnings produce. But I think the healthier version of this rally is one where we start to see broader market participation, so the so-called S&P 493. So in order for that to come to fruition, I think what really needs to happen is first, we need to see earnings delivery. And that kicks off on Friday of this week with mostly the banks.
So you're calling for this broadening of the rally, and Q2 results season will clearly be instrumental in showing whether or not we're seeing that breadth of earnings growth coming through. Which sectors outside of tech would you really expect to outperform over the coming months?
Yeah, just to set the stage for that, I think the preconditions for this broadening are first, the macro data has to hold up. And so, for example, think about non-farm payroll staying above 100,000 jobs printed each month. Second, think about the ISM services number moving back above 50. And then lastly, I would say the CPI print and PCE, more generally, those need to be trending towards 2% to get that comfort level the Fed has mentioned. The other side of this is we need to see positive earnings growth from the non-tech sectors. And so where I think you're going to see this phenomenon most acutely is going to be in financials, followed by parts of both industrials and consumer discretionary. That said, I do not think a rotation involves a selling of mega cap tech so much as I think it's that we're going to see investors put incremental dollars into those non-tech sectors.
Thank you, Drew. So financials, industrials, and pockets of consumer discretionary are all areas where you're looking to be more bullish, subject to the macro data really coming through. So honing in on Q2 results season, what will you be looking out for, and what are the risks to your bullish view?
So for this earnings season, the market expects to see approximately 4.5% revenue growth and approximately 9% earnings growth, both on a year-over-year basis. So the key risks, I would say, to the bull case, or at least my bullish view, are this. First, a significant deterioration in the labor market, right? So, because ultimately here is like if the consumer has jobs, the consumer is going to spend. Second would be a series of negative retail sales prints specifically, or general decline in consumption generally. And the third would be negative earnings growth on either a quarter-over-quarter or a year-over-year basis. Fourth would be a spike of the unemployment rate. And then lastly, I would say a material deterioration of either household or corporate balance sheets. And so what could this look like? So for corporations, we've seen more than 20% of high-yield market cap upgraded to investment grade. What if that starts to reverse? And for households, you just want to check debt levels as a percentage of income and the household's ability to kind of service their debt.
So, John, over to you. With the S&P 500 hitting those fresh all-time highs in recent days, how much investor buying have we seen alongside this? And where does this leave positioning at this stage?
That's a great question. And I think one of the things to keep in mind is that the level or rate of change of positioning doesn't always keep pace with the markets, especially when investors are already to one end of the spectrum or the other. And by this, I mean, if you look at late last year, there was a major change of positioning levels and a lot of chasing of the rally as we came off the late October lows. But throughout most of this year, the market has rallied despite positioning not changing materially. And so if I go back over the past couple of months, I would say there's a bit more of broad participation, whether it's from hedge funds or ETF flows, as well as retail and CTAs in the kind of late April to mid-May period, where there was a larger cohort of investors increasing their positioning. But over the last month, I would say the clearest positive driver of markets has been the retail investor. We see quite outsized, i.e. in line with the highest levels of retail buying of single name stocks in the past 20 days versus what we've seen over the past 5 to 7 years. If I look at other cohorts, I would say hedge funds have been a little bit more cautious. They've been selling some of their winners, especially in June. And so positioning levels at a high level, I would say, remain positive. Our aggregate measure of positioning, our tactical positioning monitor, is at the 88th percentile as of the end of last week. But relative to other periods in time, this is very much in line with what we saw in the first quarter. And the overall dynamic is fairly similar to what we saw late 1Q, early 2Q of this year.
Very interesting, thanks. So tactical positioning monitor at 88th percentile versus our history, which goes back to 2015. So with that in mind, John, do you think the markets can go higher, subject to the macro and the micro and the inflation data points coming through, as Drew just articulated? Or do you think positioning could cap the upside from here?
So I would say the market can continue to go higher if the data comes in the right form. I think about periods such as 2021, positioning was at or above these levels and the market rallied throughout the year. Or if you even go back to the first quarter, while we got to these similar levels by the end of March, we arguably were around zip code for most of the first quarter. So if the fundamental data is good and if the macro data is good, then there could be more upside. I mean, the thing that I'd be watching for, to Drew's point on, do we see a broadening of the rally, is do you get enough disinflation and enough acknowledgement from central banks that it's moving in the right direction to really propel a final push higher in terms of broader short covering, which is not something we've seen this time around. And I think that's one of the key differences from what we saw in last July, which was a similar setup to a lot of bullishness coming to the market around the AI theme. But at that point in time, you ended up getting a major reduction in shorts that ended up being sort of the peak of the market for a couple months. And that's not something you've seen yet. So I think there is that potential for broader short covering, whether it's single stocks or ETFs even, that could thrust the market higher one more time if the macro data moves more in that direction.
So we haven't seen that final leg of exuberance, so to speak, from the hedge funds yet. We haven't seen that short squeeze that we had seen last July, for example. So that, subject to the fundamentals remaining intact, could boost that final leg higher.
Yeah, we haven't even hit a positive level of flows in the U.S. from hedge funds on a 20-day rolling basis yet. So I at least want to see that turn a bit more positive before being a bit more bearish.
That's really helpful. So that's all at the aggregate level when we look at US markets. What about at the sector level? I mean, where is positioning looking more stretched versus where is it looking lighter?
So I think on the more stretched side, in terms of the level of positioning across investor types, no surprise here, but tech is that sector that stands out. So semis and tech hardware have seen positioning levels near historical highs. And I think some of this is coming from the retail side, but some of it also is just lingering exposure from hedge funds. And I'd say while hedge funds were reducing risk in semis and some of the Mag 7 stocks, in tech hardware, at least in the prior quarter, they were actually adding to risk. So I would say those are a couple that stand out on the more positive end of the spectrum. On the more negative side, I would say there's been recently some reductions in areas like industrials and materials and even financials through the middle of June. Now, some of those things have been neutralizing over the past couple of weeks, particular financials, because of what we got in terms of some of the stress test results and the rally around that. But I would say the positive end continues to be more tech related. The negative end in the US is some parts of cyclicals that I mentioned.
Thank you, John. So financials and industrials are both sectors where positioning is looking less elevated at this stage. And Drew, you are bullish of those sectors subject to this broadening of the rally playing out. So financials, industrials, certainly two segments to watch. And results season really kicks off with the financials later this week. And then, John, you've obviously got a global mandate. So turning away from the US for a second, do any other regions stand out to you as having lighter positioning at this stage and having more potential to catch up?
So I would say the one that's arguably most interesting to us in the last few weeks has been Japan. And it's obviously a market that on a longer term basis, if you look at the last few years, performed pretty well. But when we looked at how much the market had, relatively speaking, underperformed and positioning had lightened up, it was at a point at which we thought it could perform pretty well. And we were even seeing opportunistic hedge fund buying of that underperformance in June, which is something they've done a number of times in the past few years, and it's worked out pretty well. So you are seeing that work again, but that has been one of the more interesting ones. I would say the other one that gets talked about a lot, but timing is very tricky, is China. The positioning levels got arguably quite extended as of mid-May. They've been coming down to fresh lows on the hedge fund side. Futures and broader risk in China, that's also come down from a more elevated level in mid-May to a much more neutral level. But are we at the max bearish levels yet? Not necessarily. And so I think you do need the fundamentals and the overall macro story there to really turn a corner before you get investors more excited.
Fantastic. Well, so much to be watching. So thank you both, Drew and John, for articulating views today and helping us navigate markets.
Delighted to be here.
Yes, happy to be chatting again with you.
Thank you also to our listeners for tuning in to this bi-weekly podcast series from our group. If you have feedback or if you'd like to get in touch, then please do go to our website at jpmorgan.com/market-data-intelligence, where you can send us a message via the Contact Us form. And with that, we'll close. Thank you.
Thanks for listening to Market Matters. If you've enjoyed this conversation, we hope you'll review, rate, and subscribe to JP Morgan's Making Sense to stay on top of the latest industry news and trends. Available on Apple Podcasts, Spotify, Google Podcasts, and YouTube. The views expressed in this podcast may not necessarily reflect the views of JP Morgan Chase & Co. and its affiliates, together JP Morgan. They are not the product of JP Morgan's research department and do not constitute a recommendation, advice, or an offer or a solicitation to buy or sell any security or financial instrument. This podcast is intended for institutional and professional investors only and is not intended for retail investor use. It is provided for information purposes only. Referenced products and services in this podcast may not be suitable for you and may not be available in all jurisdictions. JP Morgan may make markets and trade as principal in securities and other asset classes and financial products that may have been discussed. For additional disclaimers and regulatory disclosures, please visit www.jpmorgan.com/disclosures/sales and trading disclaimer. For the avoidance of doubt, opinions expressed by any external speakers are the personal views of those speakers and do not represent the views of JP Morgan.